Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
And let's get more on housing. Stuart Paul, U.S. economist with Bloomberg Economics, joins us now. So those mortgage apps, let's start there for a second, up 11%. So talk to me about the refinancing that we saw here, because I got to say, refinancing with a 6 handle, that does surprise me. I thought we would have waited until we got at least down to the 5s.
It's interesting. So there are folks who just had to buy homes. They had to make moves for jobs. They had to end up taking out mortgages over 7%. And those folks now have the opportunity to refi, right? I mean, mortgage rates are now down about 150 basis points from the high post-COVID. Even just in the last month, they're down about 30 basis points. So for folks who bought a home because they had to post-COVID, there is some more enthusiasm about refinancing. If you unpack mortgage-backed securities, though, overall, and this is totally to your point, Alix, the average rate being paid on existing homes, the average rate being paid by homeowners is still a touch under 4%. So there is still more room to run for refinancing. This, I think, is probably, just a little bit of enthusiasm for folks who had to take out those long-term mortgages when rates were significantly higher than they are today.
It's interesting too because we were just talking about KB Home. Even though it's down today, XHB is the ETF that tracks the home building index. It's still up, trading around records, up around 28% year to date, so outpacing the broader S&P 500. But Bank of America actually was talking about how in the 3 months before and after the Fed cuts rates, home builder stocks have outperformed the S&P 500 in 3 of the last 5 such periods. So I'm wondering what particular level when it comes to, say, mortgage rates, because you're obviously covering this very closely, do you feel like you'll see more consumers come back in to try to refinance?
So it's a little bit tricky when you're thinking about home builders versus when you're thinking about refinancing, right? Because you have a few different dynamics that are at play. For people like Alix or people like me who have low mortgage rates that are locked in, you're not going to end up seeing a rush to refinancing. Your
hurdle rate to move is quite high.
Your hurdle rate to move is like close to 4.
Yeah.
Right. So there's still a ton of room to run. If you think about home builders, though, because nobody's rushing to refinance, because nobody's rushing to move if they're an existing homeowner, because they've locked in that low rate, there is room for home builders to sort of fill the gap for new households that are being formed, young people who are trying to buy their first home.
And lack of inventory, that was such a big problem even before COVID, but then was exacerbated so much that obviously that they were able to pick up that side of that demand.
Extraordinary lack of inventory, especially for existing homes for sale. The thing that I find shocking, and you'll probably have more color on this for home builders in particular, there is still just a massive inventory of new homes, new construction, and units that are currently under construction that are available for sale. I mean, levels unseen since early 2008, when housing was obviously frothy. So that's one thing that we have these two forces that are diverging for new home builders. One is just this dearth of existing homes for sale, but you do have this mounting inventory of new homes for sale that I think is going to keep new home prices under pressure for quite some time.
Which also just begs the question, like the transmission policy mechanism from the Fed, when you have sort of these structural issues that have nothing to do with what the Fed actually does. And that's an interesting sort of dynamic.
There was a question, maybe it was in the March press conference, Jay Powell's March press conference following the FOMC meeting, where somebody asked, they said, look, you cut rates to the bone during COVID, everybody refied sub 4%, and now the transmission of monetary policy while you're trying to tighten rates is really, really slow. Do you regret doing that? And he basically said, no regrets. But yeah, I mean, interest rate policy has been moving very, very slowly through the real economy. Housing is the number one sector for monetary policy and rates policy to move into the real economy. Instead, you're seeing communication tools moving into financial markets actually really quickly. The second somebody shows their hand just a little bit, you see a monster move in 2-year yields, for example. So different policy tools moving at different speeds into different parts of the economy.
It's really interesting. All right. Thank you so much, Stuart. Appreciate it. Stuart Paul, U.S. economist with Bloomberg Economics on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to take a moment here and dive into geopolitics to take a look at what's happening with Israel and Hezbollah. Israel stepping up its heaviest air attacks on Hezbollah targets in Lebanon since 2006 after shooting down the first missile ever fired by the militant group at Tel Aviv. Joining us now in studio is Bobby Ghosh, Bloomberg News Senior Editor. Bobby, can you walk us through the sequence of events in the recent week that got us here and what things you're looking at over the next, say, 48, 24 hours?
Yeah, it started, you remember, with those pages that went off. Thousands of pages exploded, most of them belonging to Hezbollah operatives and fighters. The suspicion is that Israel was responsible for them. Israel has neither confirmed nor denied it, which is there very much in the Israeli MO. The following day, there was a whole bunch of walkie-talkies, again, many of them belonging to Hezbollah commanders and fighters, that went off. Israel also then began targeted attacks against top-level Hezbollah commanders, the types of people who would be very important in the event of an all-out war between Hezbollah and Israel. Simultaneously, Israel has been essentially attacking targets across its borders with Lebanon, specifically targeting missile bases, rocket launching facilities. It's all designed to reduce Hezbollah's ability to strike at Israeli targets. Israel says that the objective is to allow Israelis who had been living close to the border and who for many months now were forced to leave their homes. It's that this entire campaign is designed to allow those Israelis to go back to their homes and live in relative peace. But depending on how you want to look at it, this can also seem like an attempt to soften up Hezbollah for a larger campaign by Israel, whether that is a ground campaign or a campaign from the air. It can give that impression.
What has the Biden administration said about these latest airstrikes? Because I know that Joe Biden just gave his final address to the UN General Assembly this week.
Well, the Biden administration for months and months now has been saying pretty much the same thing. On the one hand, it continuously repeats the shibboleth that Israel has a right to defend itself, as it does. But at the same time, it says that Israel should not escalate tensions in the region with its neighbors. And it has been warning against the risk of a larger war that will draw in Iran, which is Hezbollah's main patron, which might draw in the United States. The problem is, of course, that all of that rhetoric from the Biden administration does not seem to be moving the needle. Prime Minister Netanyahu of Israel seems to be operating on his own agenda, pursuing his own interests and paying almost no heed at all to the American president, which is not a good look for the United States.
Well, I thought it was so interesting because as we were, President Biden was speaking yesterday at the UN, we were also getting headlines on the terminal about Netanyahu and some things he was saying that was not peace and unity and ending the war in Gaza. So it was very striking. What do you think? How do you think the election impacts this in terms of what Hezbollah and Israel are thinking with 6 weeks to kind of go?
Well, there's a school of thought in Israel and in some quarters in this country that Bibi Netanyahu is holding out for the election, that he's not going to change tack until there's an election, until there's a new president in the United States. And according to this school of thought, he's betting on Donald Trump to return to the presidency on the assumption that Donald Trump will be more permissive and allow him a freer hand. I don't buy that. For one thing, more permissive than what? It's not like Biden has really been restraining Netanyahu. There's only been rhetorical attempts at restraining him, but that's not working. And also, I don't think necessarily that Donald Trump wants to come to the office with a major conflict in the Middle East to deal with. Remember, the big part of his message to his voter base is America first. The United States should not get involved too much in foreign affairs, should get out of old conflicts, particularly in the Middle East. So if that is indeed Bibi Netanyahu's calculus, that Donald Trump would be better for him than Biden, I think he may have to calculate again.
Bobby, such a pleasure to talk to you. You are always such a great reporter, and you definitely help paint a picture for us. Bobby Ghosh, Bloomberg News Senior Editor, joining us on the latest between Hezbollah, Israel, as well as Gaza.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix alongside Jen Tucker and Jess Menton. Paul Sweeney is off today. This is Bloomberg Intelligence Radio, and we are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan, where gridlock reigns. Want to get a take on the market here. Nothing's going on, so it's a good time to kind of recalibrate. What do you do as yields kind of come down? The back end, though, still stays a little bit higher. How do you position yourself for that when tech also is still outperforming? Nancy Daoud, a private wealth advisor at Ameriprise Financial and CEO of Opus, joins us now to discuss her take on the markets. Nancy, we've sort of gotten through this seminal moment with the Fed. How do you need to rethink what your portfolio looks like?
So it was a big surprise. We all bet on a quarter of a point cut, but I guess the Fed decided to front load the rate cuts. Although overall, the plan is still the same, is to get to a certain target, or by 3% by mid-year 2026. So it was a bit of an enigma as to why they front loaded this rate cut. But in digging deeper in the details, the justification really had to do largely with the inflation numbers not being quite where they really want them to be, at least 2 out of the 3 that they watch. And also the employment numbers are weakening, and that gave a little bit of concern to the Fed. So they just cut more aggressively. So now this is what we're dealing with, and I think the biggest impact was mortgage applications. I think that's probably the biggest impact in the last 2 weeks.
So what do you think the playbook is as far as what you're advising clients to buy, what you're advising them to sell? Because traditionally, I mean, every rate cutting cycle can be very different, but normally you would see, say, for instance, bond proxy like sectors like utilities outperform and tech underperform the first 6 months after a rate cut. But you've already had sectors like utilities taking off. A lot of that's tied to the AI story, and that sector's the second best performer in the S&P 500 so far this year. So where do you put your money?
Well, if you're fully invested, clearly stay the course. But I think that the reaction over the last 6 weeks and certainly over the last 2 weeks is way overdone in the stock market. And I would err on the side of caution that I think we are probably due for a pullback or even a correction or more. It wouldn't be so unreasonable at this time, because this is just overdone.
So would you use that then to add to, use that as a buying opportunity?
Well, yeah, absolutely. That's the best time, because longer term prospects obviously are very good. So if there is this correction or pullback, it's a grand opportunity to buy in or rebalance, reconsolidate how you're allocated according to your time frame and your risk tolerance. But certainly the sectors that you mentioned are very attractive. Defensive stocks will be a good play right now, such as materials, industrials, utilities. The big enigma really is energy. I still look into energy, but the big enigma has been why, with all the geopolitical risk that we are experiencing, and more so in the last week or so, why energy is down. That's a big enigma, but I would still buy it.
When you take a look at, say, if you don't get the drawdown, one part of that story is like, hey, there's over $6 trillion sitting in money market funds that belongs somewhere. Does it go into the equity market? Does it go into the bond market? Do you think that is part of this story that we're going to see?
Well, clearly broader diversification is highly indicated at this time. When you're too concentrated in one sector, you feel the volatility, and the pullback will be felt significantly more. especially in the technology sector, because that tends to be significantly more volatile. But diversification is very good right now, especially in the fixed income side, still maintaining shorter durations because it's still very iffy with the rate cuts. I do believe that the geopolitical risk is just being ignored and is not factored into the markets. And when that does happen, it could be significant.
I know that you've previously used a 4% inflation assumption in your financial plans the past few decades. I'm sure just given where the dynamic with inflation was prior to COVID, maybe your clients didn't appreciate it as fully until recent years. But with inflation having closer to that 2% target, how does that impact how you construct your portfolio models? Is that something that you'll still include, or are you going to adjust that now?
No, I will not be adjusting it because by using a more conservative inflation rate, it has really helped my clients achieve their outcomes much better. Because remember, the overall inflation rate is not the same as the day-to-day inflation rate. I'm talking about food, gas, electricity, and heat, these are the non-negotiables of everyday living. You may give up going out to eat, to travel, or discretionary spending, but you're never going to give up food, gas, and electricity. So these are the things that matter the most. And in fact, those are the things that go up the most over the last 3 to 4 decades that I've been advising clients.
All right. Thank you very much, Nancy. We really appreciate Nancy Daoud joining us, private wealth advisor at Ameriprise Financial and CEO of Opus on the markets.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance. And right now in New York City, what's happening is you have the UN General Assembly and you have Climate Week. So the benefit is we get a lot of companies now coming in that are involved in the energy transition. Then we get to talk to them about the really cool stuff that they're doing. And one of them is a company called AMSC. Now, you just look at a chart of its market cap over the last 5 years. It went from about $200 million to now almost $1 billion. It's been a tremendous rise.
And that stock's up 116% year to date.
What does it do? I'm not really sure. It's called American Superconductor Corporation, and our CEO is here to break it all down for us. Dan McGahn joining us. All right, Daniel, what do you guys do? Break it down.
We basically provide resiliency equipment for the grid today. We help bring more renewables onto the grid, and we have a nascent business that's starting to grow pretty rapidly, supporting ships in the fleet to protect them from harm's way.
So do you make the stuff that helps a solar farm plug into the grid? Are you
we're the big equipment that sits on the grid that allows that power to be able to come on and make sure it harmonizes with the grid in a way that the grid can accept it and take it. There's
been a shortage of this stuff, right? It's a huge backlog and shortage of the stuff that you make.
Yeah, we just had a record quarter where we delivered new orders about 127 million. Just to put it in context, we're about 146 for the entire year. We grew last quarter 30% versus the year ago period, and we just guided for 30% growth quarter on quarter. So we're kind of hitting it out of the park on all levels right now.
And you've also made some recent acquisitions. I read about how NWL, that's a private company based in New Jersey that provides power supplies in industrial and military customers, but then also you're getting into the wind turbine electrical control systems with some recent deals as well. So how much do you expect those types of deals to help bolster your revenue growth moving forward?
Yeah, we think that the backlog continues to grow. I think we went up from about 140 last quarter to about 160 for the 12-month backlog. Total backlog for all time is even higher than probably 200 or so. So we're in well positioned to kind of grow quarter on quarter here. That's what we just updated our guidance for the current quarter, which will end here in a week or so. And we think we're well positioned. I mean, the past year has been fantastic for us. We went from being really excited about reaching 30 million per quarter on a revenue basis to now we just got it to 50. So the business is really taking off. It's very healthy. And then the backlog is very deep along all product lines.
What's the biggest constraint that you have in delivering the key product that everyone needs to then connect to the grid?
I think if you'd asked me that question a couple years ago, I would say supply chain was part of it, just to be able to deal with the speed. Now it's really we're scaling production, we're hiring. So it's really typical type business challenges on how do you manage that growth and how do you remain effective for your customers as you grow.
And what are some of the top questions or concerns you're actually hearing from your customers at this point? And what do you think that tells us about the direction of the economy?
I think the good signs we've seen lead times on our products drop. So our lead times at one point were approaching 18 months on some products, and now we have stuff today we're delivering in 4, 5, 6 months. So the demand is growing, and the demand for products sooner is growing as well, and that's really a competitive advantage for us in the market.
Do you have a better way to move electrons? I mean, the name implies superconductors. So.
Right.
At the heart of what we do, particularly on the ship business, is about superconductors. So we move electricity in a much better way.
But you got to keep that really cold. For a superconductor.
Super cold, yeah. We do that as well. So that's part of our scope and what we deliver.
Oh, that's very cool.
We do a fully integrated system for the U.S. Navy, and we just got a contract in excess of $75 million for the Royal Canadian Navy. So we're going to be on Canadian ships as well. And that's all superconductor.
So with better lead times, is that just due to the supply constraints with the chain? Just they're not as bad as they would have been because
they're not as bad. We've done more to be able to plan. What we're seeing is customers not buying a few, but buying many, which allows us to be able to better plan our production and be able to plan our supply. So part of our growth has been larger projects, larger orders, and multiple units of the same type, which has been great for us, for our business.
So let's broaden out for a second. We've had a couple of AI data centers and energy deals. Amazon went the way of here's my own little power center that I'm going to use and connect directly to it. Microsoft went more of the way, hey, we're going to buy contracts from Constellation Energy. Constellation Energy is going to re-up one of its nuclear facilities and connect that to the grid. How do you foresee these partnerships moving forward, and how does that affect you guys?
I think it affects us because the rising tide lifts all boats. There's a huge investment in making the grid more resilient. There's more demand, be it from data, be it from AI. We see a huge potential boom coming for us because we provide power control solutions for semiconductor fabs. There's a huge move in our country to reshore that capability. Each of the chip makers, I think, individually have announced at least $20 billion of capital investment in new fabs. And that's all going to benefit for us as well, because we're building the substation level equipment. These are big pieces of equipment. They're 10, 20, some cases 60 tons. They're like big mobile home type size.
What's your level of confidence it all gets built? Because even Intel had to pare back some of those plans.
Yeah, if they build a fraction of it, it's going to be a home run for us. So I know, when people talked about, we have a play in electric vehicles and hybrid vehicles because we supply the power control equipment for the people that make the feedstocks that go into those. I think that if we're even able to get to a fraction of what people hope and desire, I think it's a big deal for our business.
So what's next? Any other potential acquisitions you want to maybe tell us about?
We have a lot of people that approach us. We've done, over a few year period here, we've done a number of acquisitions. They've all worked really, really well. We focus on good people with a good product. So, we find that there's a lot of inbound traffic our way saying, would this be a good fit for where we are? We think we can continue to grow organically and inorganically the business. We have a wonderful platform globally to be able to sell. We have a great brand in the market, and we want to continue to leverage that. And really, at the end of the day, we want to serve what our customers need and try to be there ahead of them before they really need it.
All right, Daniel, we really appreciate it. Thank you so much for stopping by. Daniel McGahn, AMSC CEO, joining us. American Superconductor. It's a great name.
It is. I was looking at the A and R function in the terminal. There's 3 buys, 0 holds, 0 sells right now.
I mean, when you have the broader thesis, it's hard to kind of find the holes there. Yeah, at the end of the day. I think it just depends also on where we go, say, with the presidential election. That's obviously a conversation that percolates right now during Climate Week. If we get a different administration, like a Trump administration, does all of this wind up changing?
Right.
I mean, many are going to say no, because the jobs are already in Republican states, for example. There's a great piece out from Jennifer Dooley that sort of looks at that and shows that a lot of the jobs added from clean energy are in Republican states.
Yeah, it's really fascinating to see kind of where this is headed. But what a run for this stock, over 100% gain year to date.
Yeah.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, well, let's get more on this nothing market here. I'm Alix, Jess Menton, John Tucker, Bloomberg Intelligence Radio. Michael Cuggino is president and portfolio manager at the Permanent Portfolio Family of Funds to discuss the latest on the market. So there's really nothing happening today. Under the hood, there's some fun stuff. You are seeing a sell-off in the bond market. So this is a great time to talk about the individual stocks, Michael, that float your boat.
Yeah, good morning, Alix. We're pretty diversified with respect to our equity holdings. I mean, when you look at the stock market, the S&P 500 today, it's trading about 21, 22 times earnings. Earnings yield about 4.5%, 4.75%, as compared to the Fed funds rate right now with the Fed's move last week of roughly 4.75%, 5%. So you have this rough earnings yield equivalent, and it becomes a question of what kind of an investor are you? Are you growth oriented? In which case it's a reasonable return for equities, plus you get the growth kicker. Or if you're more conservative, you want to take that sort of interest yield and not take on a lot of risk. So for us, we actually own both. We're in bonds and we're in stocks. On the equity side, we have a diversified approach, like I mentioned. Names that come to mind would be a Lockheed Martin in aerospace and defense, a Costco in terms of retail, Freeport-McMoRan in terms of copper and natural resources, and a mix of energy, which has been beaten down lately with Chevron and Exxon on the integrated side, and then some smaller, producers as well. Then we do have technology. We're an investor in Nvidia and Meta, and so you can see that's not one theme playing there.
You mentioned stocks and bonds. Another area that I know that you had exposure to earlier this year was gold, and it's had a banner year if you're looking at those spot prices up more than 20%. So obviously on the back of those record highs there with rate cut bets and a weaker dollar. Earlier this year, you had around 20% target weight in gold. Do you still have a weight like that? And what's your highest asset class as far as what your current holding is?
Yeah, our weighting right now, our target remains around 20%, but we're slightly overweight our target. We're probably a little less than, almost 23% gold. And that speaks to, again, being diversified. We see the gold market as being a long-term positive, even with the run-up, although I would say there may be some profit-taking and consolidation. Investors may want to wait for a better entry point. However, if you're a long-term investor, when you look at the landscape out there right now, the Fed being done and cutting on the interest rate cycle, likely that's better for real returns, and it reduces the opportunity cost of investing in gold versus earnings yielding investments. You look at geopolitical risk all over the world. You look at the development of alternative currency payment systems around the world to the U.S. dollar. You look at the U.S. dollar declining after almost really multi-decade highs. And you look at a general fear or malaise with respect to economic growth worldwide. And all these things add up to a good environment for an investor to have something in gold as a portfolio enhancer or protector.
When you talked about the portfolio and the mix and all of that, is there still value in just T-bill and chill? And when does that narrative change?
Well, for our cash and cash equivalents, that's exactly what we're doing. There are opportunities with yields coming, with rates coming down. There are opportunities to increase duration. We're doing that very selectively in our portfolio. But for our shorter term cash needs, for liquidity, and even as part of our diversified approach, we're still taking that, now it's 5% versus 5.5%. And it may come down a little bit further, but you're still talking, risk-free earnings. I don't think the Fed's going to cut that drastically, in the next year and a half or so, all the way down to, 3%, 3.5%, the terminal rate. I think they ought to maintain a sort of slight tight bias personally. So you're still getting risk-free money for your cash, at worst 3.5%, maybe in the 4s, maybe closer to 5. And so as part of a diversified approach, it makes sense for us. If you're an investor that's the only thing you're doing, I think you may be selling yourself short unless you're very, very risk averse. I think you can make more by being more broadly diversified in a number of different areas.
What about when it comes to the REIT side of things in the equity market? When you have rates coming down, what's your broader outlook for real estate? And do you own those corner of the market with those stocks?
Yeah, we do own some REITs, and I probably should have mentioned that is one of our asset classes that we focus on. And you are right that with rates coming down, REITs generally are attractive in that environment. And so I see that as being a good long-term area as well. And we're spread out among a number of different industry subsectors within real estate. And so I think the one thing you do have to be careful of a little bit here in REITs would be the balance sheets. Even though it appears that the markets may have sidestepped the big credit crisis due to a major refinancing of some of the debt at these higher yielding debt deals, especially if rates are coming down, I think you still need to focus on the balance sheet to make sure your companies are not unduly exposed to credit risk. Other than that, so asset quality is something you always look at REITs anyway, so it's nothing new here. Yeah. But investors should be careful in that part of the REIT sector.
Hey, Michael, super appreciate it. Thank you so much, Michael Cuggino, President, Portfolio Manager, Permanent Portfolio, Family of Funds.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One other story that really caught my eye today was about colleges and how some higher education systems here in the U.S., it is crazy, right? Like Princeton is so expensive, they compete with Harvard, the whole thing. But apparently other universities now, like Northeastern, are trying to tap a Wall Street playbook so they can rival Ivies on admissions. This obviously caught everybody's eye. It's one of the top reading stories on the Bloomberg terminal. Francesca Maglione is personal finance and higher education reporter, and she joins us now in the Bloomberg Interactive Brokers studio. Okay, can you just walk us through the premise here?
Yeah, so Northeastern University has been known for years as a commuter school, mostly attended by local students. And since 2011, they've kind of been expanding their brand. They now have 14 campuses across the world with 3 campuses abroad. What we thought was interesting is that since 2019, they've been buying up other struggling schools, kind of tapping in that private equity playbook. And
like an M&A.
Yeah, like they've merged with 3 different schools so far and kind of embedded the Northeastern brand on these schools, and now can offer to students like, hey, you can study for a semester in California, you can do a semester in New York. And this is very different from those schools like Princeton and Harvard, which just want to stay small and elite. They want to expand their brand as much as they can.
Because there's a lot of schools, especially in the South where I'm from, where you had a lot of magnet schools and then satellite schools, whether it was like the University of Texas or Texas A&M. So you'd have not just the main campuses, say in Austin, Texas. You had ones in say Dallas and outside of that. So I'm wondering, is there a particular playbook when it comes to kind of like the M&A type of feel it comes to something like this, or is there different, not apples and apples, I guess?
Yeah, I guess what's interesting with Northeastern is that higher ed is going through a very hard time. There's a lot of smaller schools that are closing all over the U.S. And so Northeastern is growing at a time when all of these other colleges are shrinking. Colleges are competing for students. The number of students across the U.S. is going to drop by 10%, the number of students going to college.
Really?
And so
why? What's the driver there?
It's just a demographic cliff.
And so the cost, the insane amount of cost, I'm sure has
extremely expensive as well.
Yeah.
COVID was really bad for the college enrollment numbers as well. And so Northeastern is kind of growing at a time when all these other schools are shrinking. And when looking for schools, they want valuable real estate. The latest acquisition that they have is in New York. Now they have 3 buildings in Manhattan.
Did they buy Marymount, or was this part of the Northeastern
Yes,
thing?
they don't call it buying because
Marymount still has its own brand.
They just swallow their liabilities and their assets. There's no exchange of money that changes hands.
Oh, interesting.
Yeah.
Is it working? Is this playbook actually helping Northeastern?
Yeah, it's working. Northeastern last year had almost 100,000 students apply to their university. They've seen their enrollment increase by 15% since 2019. And they've gone from being just a local, little known brand to being known worldwide.
Wait, does it help? But see, part of the college thing is like the experience, right? Like you go there and you live there. Like maybe you take a semester abroad or something, but like you stay there. And it feels a little weird and disjointed to then all of a sudden be like, you're here and then you're there and then you're here and then you're there.
Yeah, for sure. That's one of the things that Northeastern will say is changing within higher ed, and that's why they've been successful in this moment. They think that students no longer, or some students no longer want to, spend 4 years in one place with a small community, and they're looking to get new experiences and be more practical in terms of their 4 years. How can this translate into career after college and things like that? So that's another way that they're different from other colleges.
Are there other potential universities or colleges that are eyeing this type of model and they may try to do and replicate something similar?
Yeah, for sure. Northeastern's told us that they've heard from almost 50 schools that have reached out kind of interested in either merging with them or learning about their business model. We saw that Vanderbilt has now a campus in Florida. That's kind of a school that's trying to do something a little similar, not at the scale that Northeastern is doing it. But there's a lot of schools watching what they're doing right now, yeah.
So is what they're doing also, though, different from that Marymount thing? Like, I can still go to Marymount here, say, in New York City versus Northeastern, and then I go spend a semester in California.
Yes, so Marymount is part of their whole plan.
Okay, so that is part of it.
Right now, they're still Marymount because the merger was just announced, but eventually it'll be Marymount at Northeastern or whatever brand they decide to go with, yeah.
So then I can go to Northeastern and then be like, I'm going to spend a year in New York going to Marymount.
Yes.
Nice.
Okay.
Yeah.
Yeah, that's just so interesting. It's just such a different college experience when I would have been used to. I would think that you go to college, you learn how to be by yourself, do laundry by yourself, get into debt by yourself, drink beer by yourself, and then that's it. Not jet setting off to different locations. Yeah. Francesca, thanks a lot. It was a really great piece. Really appreciate it. Francesca Maglione, personal finance and higher education reporter, joining us.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.